Hello everybody, welcome back to the channel. Today we've got a long form video, so get set for some learning. Now let's go over to the article and let's start learning. We'll have a lot of commentary here because this is a long form video. So the block, learn stablecoins and cross-border payments, how digital dollars move across borders. So let's begin the article, and then we'll add some comments from time to time. Stablecoins are a type of cryptocurrency designed to hold a fixed value against a reference currency, most commonly $1 US. Transferring stablecoins across countries is unlike transferring money through a bank. A sender converts their local currency into a stablecoin, sends it to the recipient's blockchain address via blockchain network, and the recipient then converts it to their own local currency. Recently, this is being recognized as an often more efficient and cost-effective method of moving money for international remittances. In this article, we'll cover the mechanics, benefits, and drawbacks of stablecoins in cross-border payments. What is a stablecoin and why does it matter for payments? A stablecoin is a token that promises redemption at par against a reference currency backed by reserves the issuer holds in cash and short-term government debt. Almost the entirety of the stablecoin market is based on US dollars, with Tether's USDT and Circle's USDC forming a duopoly that accounts for over 85% of the market. Stablecoins are useful for payments because they are pegged to a single stable value and can be transacted anytime, anywhere without an intermediary like a bank. This gives them certain advantages over traditional payment rails. Why are traditional cross-border payments slow and expensive? Traditional cross-border payments or bank remittances are slow and expensive because they require multiple compliance checks, processing times, and fees across multiple parties. They are also limited by the bank's working hours. For example, a payment done on a Friday afternoon in New York cannot reach its recipient in Mumbai until the next business day on Monday. How do stablecoin cross-border payments work? A stablecoin payment has three legs. The on-ramp, a business or consumer deposits local currency to a licensed stablecoin provider, oftentimes crypto exchanges, brokers, or payment platforms who convert the currency into stablecoins. The on-chain transfer, the stablecoins move from the sender's wallet to the recipient's wallet via the blockchain, which often takes seconds to a few minutes depending on the network. The off-ramp, the recipient can then convert the stablecoins via similar crypto exchanges, brokers, or payment platforms into their respective local currency. It is worth noting that this part of the transaction is where most of the friction and added costs are, because local platform liquidity can be dry and forex spreads can be costly. Compliance and screening. The firms that operate the stablecoin on and off ramps are responsible for compliance obligations, as they are tasked with monitoring wallet addresses against sanctions lists and filing the same reports a traditional money transmitter would. So we see on this table here, we've got the feature, the correspondent banking, and the stablecoin rails. So settlement time, same date up to 5 business days, but with stablecoin, seconds to minutes on chain. Now with operating hours, with traditional banking, you've got traditional business hours and then weekday cutoffs, but of course stablecoin can be at any moment in time, 24/7, days a week. Intermediaries, so you have 2 to 4 banks per payment, okay, traditionally. But with stablecoin, you have the issuer, which is USDT, USDC, and then plus on-ramp and off-ramp partners, meaning your own wallet or a centralized exchange wallet. Depends if you are going to jump out of USDT or jump out of USDC into a local currency, because that would be, of course, the off-ramp. Now, pre-funding, it says no store balances in each currency when it comes to traditional banking. And then, of course, with pre-funding, it just means the working capital and tokens, which means you've already are in USDT, already in USDC. Fee structure, we got wire fees, of course. You've got lifting fees and then FX markup. All of that is quite the secret sauce of how banks make their money in many ways. But when it comes to stablecoins, you've got a traditionally tiny network fee and increasingly more competitive. And then usually if you are going to, again, get out of your stable, that's when you have a provider fee sometimes, and then these conversion spreads, especially if you're going back to a traditional currency. So where the costs are concentrated. So usually it says here for banking, intermediary deductions and the FX. But over here, it would be off-ramp liquidity and local foreign exchange. So reversibility with traditional banking, recall is possible through the network, yes, but perhaps the downside, some might say, would be that if you are sending a transaction from one stablecoin sender to a recipient, it's not necessarily reversible unless the recipient consents to send it back. And then regulatory perimeter bank supervision in every jurisdiction, that is the standard. But then when it comes to stablecoins, you have issuer licensing, such as with Tether or Circle USDC, and then you have plus payment licensing at each ramp, meaning are they able to offer this type of payment solution if it's not going to be maintaining in USDC or USDT. So now this part of the article says which cross-border use cases have actually worked. So B2B payments, business-to-business payments are the largest example, almost certainly. So it says with treasury management being the second, where companies can move liquidity between their own international entities and wallets without having to wait for traditional banking hours. So payouts from freelance marketplaces are also a notable example, as freelancers based in countries with weak, highly inflationary currencies can choose to be paid in a relatively stronger US dollar via stablecoins. And then consumer remittances are the most famous example, but actually account for the least volume. BVNK, which processes about 300 billion in annualized stablecoin payment volume in 2025, reports that most of its flow is B2B rather than person-to-person, peer-to-peer, likely because P2P stablecoin transfer sizes on consumer apps are worth $47 on average compared to $250 for a traditional remittance. Now, the next section, who is building stablecoin payment rails? So issuers and their networks. So Circle launched the Circle Payments Network, CPN, in 2025 to connect banks, payment service providers, and virtual asset firms into one settlement layer. Remittance company, so Western Union launched a stablecoin in May 2026 issued by Anchorage Digital Bank on Solana. And then Bitso also reported processing over $6.5 billion of US to Mexico remittances in 2024. And then card networks and processors, so Visa accepts stablecoins and allows some cardholders to spend USDC at merchants. MasterCard also added intraday, weekend, and holiday card settlement in 6 regulated stablecoins across 8 blockchains in the United States and Latin America. And it says Stripe bought the stablecoin infrastructure from firm Bridge for $1.1 billion, extended stablecoin acceptance to merchants in more than 100 countries, and backed Tempo, a blockchain built specifically for payments. Emerging market fintechs. Providers in the corridors themselves have built much of the working infrastructure. Nigeria's Paga is deploying stablecoin payments for freelancers and businesses paying overseas suppliers. Nigeria accounts for roughly 60% of stablecoin inflows into sub-Saharan Africa since 2019, according to the IMF. So how much cross-border volume actually moves on stablecoins? It says here, of roughly $35 trillion in annualized stablecoin transaction volume, it is estimated that just less than 1% represented genuine payments such as supplier invoices, remittances, payroll, and card spending. The remaining 99% represented trading and on-chain activities such as arbitrage, bridging, and bots. These are still the primary use cases of stablecoins, while cross-border payments and other real-world utility remains in a proof of concept phase. What are the risks and limits of cross-border stablecoin payments? So here we go. Off-ramp liquidity and local FX, which we've touched upon. It says here, while the blockchain leg is fast and cheap, converting tokens into emerging market currencies in large amounts may not be possible due to the high foreign exchange spreads and low liquidity. So that's really the last mile is still kind of a point of friction. Now, reserve and redemption risk. So a stablecoin holds its peg as long as the market believes the issuer has sufficient reserves and can redeem on demand. For example, USDC broke its peg in March 2023 when Silicon Valley Bank failed before recovering days later. Accounting and tax treatment. A single company paying suppliers across Brazil, India, and Nigeria may face 3 different accounting treatments for the same stablecoin transaction. Finance teams have to reconcile token movements against fiat books, and guidance in many emerging markets is still incomplete. So we can talk about Crypto Deposit, our platform regarding this a bit later. So we've got end-to-end bookkeeping all on chain. Now, issuer concentration. Tether and Circle together account for nearly 90% of stablecoins supply, and a payment network built on just 2 issuers naturally inherits their operational and regulatory risk. So here, issuer concentration, it's just saying that, yeah, basically USDT, USDC, still quite a huge percent. Now, next section, how are stablecoin cross-border payments regulated? Regulation now runs through licensing regimes for issuers, and the frameworks differ enough to shape which tokens can be used in which jurisdiction. So in the United States, stablecoins are governed by the Genius Act, while Europe has the MiCA. So of course, we got the jurisdiction on the left, the framework on the right, meaning what is the updated legal framework, and then on the right, the status as of the month of July 2026. So the United States Genius Act, it was enacted in July of 25, about a little over a year ago, and implementing rules proposed but not final, effective January of 2027, coming up next year. Then in Europe, the EU, you've got MiCA, and that was very recent. We have some videos on the channel. Fully enforced transition ended 1st of July 2026, and unauthorized tokens are delisted, or at least not available. And then Hong Kong, you've got the Stablecoins Ordinance, and it was in force since August 1st, 2025. First 2 issuer licenses granted April 2026. Singapore, you have, of course, the Monetary Authority of Singapore, MAS, Single Currency Stablecoin Framework. It was finalized back in 2023, and the redemption at par within 5 business days. So that is the way they function. Over in Japan, you have the Payments Services Act amendments. So issuance is limited to banks, trust banks, and funds transfer providers. So you really have to be pretty large local institution in Japan to have that ability. Other folks cannot do it. Over in Brazil, central bank forex rules, stablecoin operations classified as foreign exchange activity in November 2025. So that means a little over half a year ago in November 2025, the Brazilian government made it a central bank forex rule. So any stablecoin operations are specifically classified as a foreign exchange activity. And then over in the UAE, United Arab Emirates, it's called payment token regulation. So it's in force with full reserve backing required, meaning that any stablecoin needs full reserve backing at all times. So how are banks responding? Banks are building tokenized deposits rather than adopting stablecoins. That's an interesting comment. So a tokenized deposit is commercial bank money recorded on a blockchain, held on the issuing bank's balance sheet and covered by deposit insurance. On the other hand, a stablecoin is a claim on a non-bank issuer's reserve pool. U.S. banks such as JP Morgan, Citigroup, Bank of America, Wells Fargo, and more than a dozen others announced a tokenized deposit network through the clearinghouse in June 2026, targeting a launch in the first half of 2027. Although not an example of stablecoin adoption, these examples do show that banks are responding to the benefits that blockchain rails offer over traditional banking. So again, although not an example of stablecoin adoption, these many banks show that they are responding to the benefits of using the technology of blockchain rails over traditional banking. So that's really what we're addressing as well. Now, what should institutions evaluate before using stablecoin rails? Case-by-case cost comparisons. For example, a stablecoin payment rail that looks 4% cheaper on the blockchain leg can turn out to be more expensive after local currency conversion spreads, with pricing varying sharply by country and payment method. Licensing is another consideration, as a stablecoin in one market may be unavailable to a licensed counterparty in another. So treasury teams operating in multiple jurisdictions need to keep that in mind. And operational work is also a factor, as reconciliation between on-chain and fiat records, custody of the stablecoins, sanction screening of counterparty wallets, and internal policy for irreversible payments have to exist beforehand. So that is quite a lot of sort of compliance. This is really a key factor for companies and organizations. So this is actually probably the key point in this article we can address again. Now, FAQs, frequently asked questions. Are stablecoins actually cheaper than a bank wire? Oftentimes, yes, but it depends on the specific case. On-chain transfers often cost a few cents regardless of amount, but the conversion into local currencies at the receiving end carries a spread that varies by market. How fast is a stablecoin cross-border payment? A stablecoin transfer via a blockchain is confirmed in seconds to a few minutes. Which stablecoins are used for cross-border payments? USDT and USDC dominate with about 184 billion and 73 billion in circulation as of July 2026. Are stablecoin payments legal? Yes, in most major jurisdictions. The Genius Act governs U.S. payment stablecoins. MICA governs the European Union, and Hong Kong, Singapore, Japan, and the United Arab Emirates each license issuers under their own regimes. Can a stablecoin payment be reversed? No. Once a transaction is confirmed on-chain, no party can recall it. Could stablecoins replace SWIFT? Unlikely. SWIFT moves payments instructions between more than 10,000 institutions and has extended that network to tokenized bank deposits. Why do central banks worry about stablecoins in cross-border payments? Dollar-denominated tokens give households and firms in emerging markets an easy route out of their local currency, which some argue weakens monetary sovereignty and bank intermediation, as stablecoin holders in those regions can be largely unaffected by U.S. capital controls. What happens if a stablecoin issuer fails? Holders become creditors against the issuer's reserve pool, and recovery depends on the applicable insolvency regime with no government-insured backstop. So this was a very interesting article. It covers many topics. It covers the pain points. It covers the trends of banks. We've really learned a lot, and hopefully people really enjoyed that. It was a great article to read through. I know I got a lot out of it. So in conclusion, in summary, we're just going to note that usually if you are going to be sending stable coins, especially, for example, these freelancers, the most likely way to maximize the activity is that you receive USDT, you don't go back to a local currency or that Forex, and then eventually you're paying all your bills in USDT. So you're fully in the US dollar regime. Everything is via stable. So a lot of people are doing that. So they're not obliged to go into the local currency, and that's addressed here at the bottom of the article, because really for a lot of governments that are not USDT, so a lot of countries have central banks that are worrying about stable coins because it gives individuals, it gives families, it gives firms in a lot of these emerging markets an easy, or rather easier route away, and to avoid the local currency, which might be just a big mess. And so a lot of these governments will argue that, hey, these stables are a threat. They're weakening monetary sovereignty and bank intermediation, which is technically true on both, but that's the prerogative of individuals, people, leaders of households, people who are freelancing and getting paid in stables. And so again, stablecoin holders in regions can largely be unaffected by U.S. capital controls. But that's a double-edged sword, because of course the Genius Act does govern stablecoins inside the U.S. But what's the jurisdiction of a USDT holder or a USDC holder? As you see here, number 8, what happens if the stablecoin issuer fails? So in that unlikely event, or who's to say it is unlikely? I mean, USDT and USDC do have, as you see here, they can become creditors if you're a holder of USDT or USDC in the event they Tether or Circle becomes insolvent. And then, of course, the issuer's reserve pool, meaning any assets on hand that Tether has, such as debt notes, debt instruments, gold, precious metals, and recovery depends on the applicable insolvency regime. So Circle would be out of New York City, and then it seems that Tether is out of somewhere in the Caribbean, I think the Bahamas. Now, the other key note here is that at the top of the article, less than 1% is really truly peer-to-peer and payments such as invoices, remittances, payroll, card spending, and then the other 99% is really computers. So trading, on-chain activity, arbitrage, bridging, and bots. So although there is such a large amount of stables out there, the majority of it is not really being used for individuals. But of course, 1% of 35 trillion would be 350 billion, which is not bad. So 350 billion is 1% of 35 trillion. Now, the reason we at cryptodeposit.org, this YouTube channel, we are so adamant about stables, it's really the key offering of our platform, is that because anybody can come, anybody can use a card, it can use a bank wire, that's all set up here. All you got to do for self-custody is connect a wallet such as MetaMask. You're also welcome to try our partner platform Crypti if you want to check that out. And the next step, which is really just really 1 or 2 steps, you're able to get USDC from cryptodeposit.org. You're able to get USDT from cryptodeposit.org. And then ideally, the final step, if you really want to maximize, is you take your USDC and you take your USDT and you commit it to as little as 7 days up to 5 years, and a yield curve, which is also adjustable over time. And then, of course, you can have your same wallet receive that interest and yield at the end. So the principal plus the yield after those 7 days or 5 years or 90 days or whatever. Alternatively, you can direct and designate a different recipient, a different repayment wallet once that bill has come to term. So if you have anything already in, once your wallet's connected, it'll show your bills here. So anything that's active or ongoing, it'll be populated here. Borrowing and lending is simply your wallet's connected. If you have anything that's not stable and you wish to borrow more stable, that would show up here. And then for a lot of people, OTC. So it's simply, this tab is for all the people who have 50,000 or more. Just fill out this form, submit a request for proposal, and it goes both ways. You can be getting stable, or of course, we are also accepting stable, and we can wire you fiat. So it's simply an OTC deal, and then many types of fiat as well. And then finally, statement activity. It's like everything is in real time. So any activity at all, like a bank statement, is here, all on chain. XMTP. So anybody else using Crypto Deposit, you can message them wallet to wallet. There's anonymous ways to hide your wallet address as well. You can use a sort of a nickname for your wallets. You can do video calls. Everything is purely wallet to wallet, so you have custody at all times. And then, of course, activity history, and then exchange and swap. So that is who we are at cryptodeposit.org. We love stablecoins. We cover everything about stablecoins as much as possible. We've got a white paper where there's a white paper video. And then with that being said, we are wishing you all a great day, a great afternoon, a great evening. Hopefully you guys enjoyed this long form video. Hopefully you want to learn as much as possible about the 35 trillion plus market for stablecoins, which we are covering all the time, and we are immersed in, day out here at cryptodeposit.org, including our partner platform. So wishing you all a good rest of your day, and we have a few more exciting videos coming up that cover industry news such as stables and such as regulation and legislation relating to stablecoin payments and how governments and banks deal with stablecoin payments across the world. See you on the next video coming up in just a short while. Have a good day, everybody.